Welcome to The Interest. I'm Katie Jensen. Today is Thursday, so we'll be taking a look into David Luna's crystal ball to see whether inflation will level off this year. But first, things continue to move and shake in this industry, like Movement Mortgage's reported shift into reverse mortgage. What's more shocking, though, is Fitch downgrading Fannie Mae and Freddie Mac after the U.S. rating cut. This apparently ticked off White House officials and surprised investors. Does this mean we'll see mortgage rates move as well? Stay tuned for more details coming up.
My name is Thomas Hall. I went ahead and used the Southwest AI app, and I put in a difficult loan scenario with some tax returns and everything, and I had somebody else already underwrite it. When it came back, it was almost identical within like a few dollars, and it took about 30 minutes instead of a whole day or two for somebody to analyze that. So yeah, that AI is going to be the best thing in the whole industry. So stay tuned.
Welcome back. Rating agency Fitch downgraded Fannie Mae and Freddie Mac from AAA to AA+ yesterday after the U.S. rating downgrade Tuesday. Tabrasa Chief Revenue Officer Bill Bodner demonstrates what this means through a lending analogy. He says borrowers with low income and high debt get a higher rate on their mortgage because they're at a higher risk for default. The same notion applies to the government agencies who are holding these kinds of high-risk loans. The last time Fitch downgraded U.S. mortgage debt was in 2011, and that ended up improving mortgage rates. But analysts are saying that is not to be expected this time around. The difference between then and now is we have $26 trillion more in debt. Mark Fleming, chief economist for First American, says the yield on the 10-year Treasury is little changed today, suggesting the downgrade will have little impact on mortgage rates. He added that inflation and a healthy labor market are much more important. U.S. Treasury Secretary Janet Yellen strongly disagreed with the Fitch rating decision. That's mainly because the report cited, quote, eroded confidence in fiscal management. A senior Biden administration official called Fitch's downgrade, quote, bizarre and baseless, claiming U.S. governance improved during the Biden administration. In other news, Movement Mortgage is expanding its product offering to include reverse mortgages. The South Carolina lender hired industry veteran Harlan Akala as National Reverse Mortgage Director. Prior to joining Movement, Akala had been the National Reverse Mortgage Director for Fairway Independent Mortgage for 8 years. At Fairway, he built and led the reverse mortgage division into a perennial top 10 reverse mortgage lender. Coming up, David Luna shares his expectations on inflation levels going forward and whether the worst is already behind us.
Don't miss the largest mortgage show in the nation. The Originator Connect returns to Planet Hollywood in Las Vegas August 17th to the 20th. See us at originatorconnect.com. Find the best connections in the industry, dozens of sessions, scores of exhibitors. It's where success is written every hour. originatorconnect.com.
We have all received the reminder from the NMLS that our CE is required in order to renew our licenses for 2024. There's been some concern that some have not renewed and have left the industry for their own reasons. We wanted to remind you that you can get your CE requirements taken care of for free by attending one of the many events presented by the Originator Connect Network. You can find events at originatorconnectnetwork.com. We've heard from Chairman Powell of the Federal Reserve about raising the Fed funds rate. What you may not be familiar with are the sentiments of others. Cleveland Fed Chief Loretta Mester, speaking in California, recently said, in order to ensure that inflation is on a sustainable and timely path back to 2%, my view is that the funds rate will need to move up somewhat further from its current level and then hold there for a while as we accumulate more information on how the economy is evolving, close quote. San Francisco's daily, a couple more rate hikes will likely be needed this year. Fed Barr said on Monday, quote, I would say we're close, but we still have a bit of work to do, close quote. Recently, the reports they have seen are looking better for the economy, but we may not be over all the hard parts yet. For example, look at the payroll numbers. June payroll growth deflated to 209,000, the lowest level since December 2020. April and May employment was revised down 110,000, and it was the first time in over a year that growth fell short of market expectations. Remember, folks, we need people to be employed and earning money in order to qualify for their mortgages. I believe the worst of the inflation concerns are behind us. For example, CPI. It has steadily been dropping. June CPI continues to show a steady, positive improvement. For example, it was 9% last summer, 8% in the fall, 7% over the holidays, 6% in the early months of 2023, and now it's in at 3%. PCE, or Personal Consumption Expenditures, a favorite index that the feds like to look at, has been improving, with the next release coming out July 28th, 2023. Manufacturing is also slowing, as are other indicators. It does appear that the worst is in fact behind us. The Producer Price Index, or PPI, was only up 0.1% for June. Those that are still in the industry and have kept up with their referral partner relationships, you are about to be greatly rewarded for your efforts. Consumer sentiment, as well as builder sentiment, are also climbing. Fannie Mae has a Home Purchase Sentiment Index, or HPSI. This Home Purchase Sentiment Index increased 0.4 points to 66, while most of the index's 6 components were little changed month over month. Survey respondents did report that home buying conditions improved slightly in June over May. This is David Luna with Mortgage Educators in Compliance, better known to you all as MEC.
Thanks, David. For more on these and all of today's top stories, visit nationalmortgageprofessional.com.